We're looking at three significant transitions in the global economy in 2016. The first, by far the most important of those, is an end to 7 years of ever looser monetary policy in the developed economies. Of course, the Federal Reserve is leading the way with a sequence of rate hikes over the next couple of years. But don't forget, European Central Bank and the Bank of Japan, they're probably done with their loosening policy as well. Now, policy will stay loose, but the direction is going to be towards tightening over the next 2 or 3 years. The second big change is the transition in China away from a very high growth economy towards slower growth, service sector led, and hopefully that is going to be a more resilient and more sustainable picture. They've still got huge problems in terms of transitioning away from their massive credit bubble, but the first steps have been taken and we can see an intention to shift the focus of growth. The third transition is going to be in the emerging markets, because these have had a few tough years with falling commodity prices, weak exchange rates, but we can see the beginnings of an adjustment, we can see the beginnings of a policy response, and I think there'll be a slight pickup in growth as some of these economies come through the worst and start to improve a little bit in 2016. So 3 big transitions. Overall, the global economic outlook is reasonably bright, and of course the market issue is really going to be dominated by the question of how fast the Fed raises rates over the next couple of years.
The title of our 2016 market outlook is Swinging onto Higher Ground. Driven by impending rate hikes by the Fed, we believe global stock markets will trade in a broad range and with higher volatility, not dissimilar to the 1994-96 period when rates rose. 2016 is likely to be a year where alpha or ideas-specific returns play a more important role than beta or general market returns. Some alpha strategies include investing in thematic and yield carry, selling optionality, and investing in non-core related strategies. An equity theme we like is investing in companies that demonstrate strong wide moat and innovation characteristics. Innovation has been a key success in many technology and healthcare companies as they have consistently generated excess shareholder returns. Selling optionality is another way to extract incremental returns. Given our broad range and higher volatility market view, portfolios can benefit from generating premium income via selling covered call options on stocks that are viewed to be trading below their fair values. Investing in non-core related strategies not only enhances robustness of a portfolio, it can also add alpha. We like hedge funds with good long-term track record in strategies such as long-short equity, global macro, and multi-strategy. This month, we upgrade Asian equities to a neutral weighting after staying underweighted over the past 3 years. This is on the back of compelling valuations, especially against the US market. European equities remain our favorite due to tailwinds from negative interest rates as well as possible extension of quantitative easing. On bonds, we expect compression of yield spreads to offset the drag from higher rates. Past market cycles suggested that each time rates started to rise, yield compression took place. Thus, the yield carry strategy via overweighting emerging market high yield bonds is likely to produce superior returns over low-risk government bonds. There are obviously risks that we should be watchful over. Can the government in China engineer a soft landing in its efforts to rebalance the economy? And will the Fed be quickening rate increases? Are two risks that we are mindful of.